Hello everyone, welcome back to Boss Economic World. I'm your host. We analyze the truth behind economic events with a touch of humor and restore the full picture concisely. If you want to know where the money is going, and more importantly, where it's disappearing, you are in the right place. Today is December 15th, 2025. Grab your coffee, or perhaps something stronger, because the economic data sheet that just came out of Beijing this morning is, to put it mildly, a splash of ice water in the middle of winter. We have been talking for months about the one-leg giant, an economy that is sprinting on the leg of manufacturing exports while the leg of domestic consumption has atrophied. Well, today's data confirms that the giant isn't just limping, he's starting to stumble. China's investment has slumped further. Retail sales have expanded at their weakest pace since the dark days of the pandemic crash. We are looking at a lopsided growth model that is not only failing to ignite the domestic engine but is also actively pouring gasoline on the fire of trade tensions with the rest of the world, specifically the tariff war unleashed by President Donald Trump. Today, we are going to peel back the layers of this onion. We will look at the alarming retail numbers, the mystery of the vanishing investment, the property precipice involving Vanke, and what 2026 holds for your portfolio. Let's start with the headline number that has Wall Street analysts scratching their heads and rewriting their spreadsheets. Retail sales rose just 1.3% in November from a year ago. Let that sink in. 1.3%. In an economy that targets 5% GDP growth, a 1.3% rise in consumption is essentially a recession in the shopping aisles. This is the slowest figure on record, barring the chaotic lockdown periods of the pandemic. Bloomberg surveyed a legion of analysts, smart people with expensive degrees, and the median forecast was 2.9%. The reality was less than half of what the pessimists expected. What happened? The National Bureau of Statistics gave us the official line: unfavorable statistical effects and insufficient domestic demand. But let's translate that into plain English. 1. The hangover effect. Remember Singles' Day? That massive shopping bonanza usually centered in November? Well, in 2025, the promotions started earlier than ever, back in October. Consumers, looking for any discount they could find, front-loaded their purchases. They bought their toilet paper, their winter coats, and their gadgets in October. By the time November rolled around, their wallets were empty, and their appetite was gone. This cannibalization of sales explains part of the drop, but not the severity of it. 2. The subsidy cliff. This is the more worrying structural issue. Late in 2024, the government rolled out massive subsidies for household purchases, the trade-in policy. It was designed to get you to swap your old clunker of a car or your noisy washing machine for a shiny new one. It worked, until it didn't. The data from November shows the effect of these subsidies has turned from a tailwind into a headwind. Home appliances slumped 19% year over year. That is the worst reading since early 2020. Car sales fell 8%. The biggest drop since May 2022. As Lin Song, the chief economist at ING, rightly pointed out, the policy impact has faded. It's like giving a runner a shot of adrenaline. They sprint for a lap, but once it wears off, they crash even harder. Unless the government expands the trade-in policy to cover new categories, maybe trade in your old furniture? Your old clothes, we are out of ammo on this front. 3. The wealth effect is dead. You cannot convince people to spend money when they feel poor. With the stock market fluctuating and, more importantly, home prices continuing to nosedive, the average Chinese household's balance sheet is shrinking. When your primary asset is losing value every month, you don't go out and buy a new EV. You save. You hoard cash. If the consumer story is depressing, the investment story is historically significant. Fixed asset investment shrank 2.6% in the first 11 months of the year. If this trend holds for one more month, and there is no reason to believe it won't, 2025 will mark the first annual drop in fixed asset investment since 1998. We are going back to the Asian financial crisis era here, folks. For decades, investment was China's middle name. Build bridges, build roads, build factories, and GDP goes up. So, why is it shrinking now? The infrastructure paradox. Usually, when the economy slows, Beijing orders the local governments to dig holes and fill them up again. Infrastructure spending goes up. But this time, infrastructure investment is showing a rare decline. Why? Because the local governments are broke. Beijing has tightened control over local borrowing to reduce financial risks. They launched a massive hidden debt swap program. Essentially, they allowed local governments to issue new special local bonds to pay off their dangerous, high-interest off-the-books debt. The problem? This money is being used to refinance old debt, not to build new things. About 70% more special bonds were issued than planned, but that money is just moving from the left pocket to the right pocket to keep the creditors at bay. It's not buying cement. It's not hiring construction workers. The data correction theory, the slump in capital expenditure, began in June and has been so severe that it has puzzled economists. Goldman Sachs estimates implied a contraction of around 11% in November alone. Some economists are whispering that this might be a kitchen sinking moment. Authorities might be using this period to correct years of over-reporting in the statistics. They are finally admitting that the investment numbers of the past were, let's call them optimistic. If true, this is painful but healthy. It means we are finally seeing the real floor. We cannot talk about the Chinese economy without talking about the elephant in the room that is currently having a heart attack: real estate. Real estate investment plunged 16% in the first 11 months. Home prices in November fell faster than in previous months, reversing the tiny bit of stabilization we saw earlier in the year. The scary story here is China Vanke Company. Vanke was supposed to be the good student. It was the developer that was managed well, had state backing, and wasn't reckless like Evergrande. But in November 2025, Vanke moved closer to the brink of default. If Vanke falls, the psychological blow to the market will be catastrophic. It tells every homebuyer, no one is safe. Raymond Young from ANZ Banking Group nailed it: the contraction of real estate activities and the slowdown of retail sales are moving in tandem. It is a vicious cycle. Property drops - people feel poor - retail sales drop - companies earn less - wages stagnate - property drops further. Now, you might be asking, if consumption is dead and investment is dying, how is the economy growing at all? The answer is industrial output, which grew 4.8%. China is currently relying entirely on foreign demand to keep the lights on. The factories are humming. Exports have been booming in 2025. But here is the trap. Much of this export boom is front-loading. Manufacturers and global buyers knew that President Trump was coming back with his tariff war. So, everyone rushed to ship goods out of China before the tariffs hit. We are now seeing the end of that rush. Exports are forecast to slow significantly in the coming months as protectionism spreads, not just from the US, but from Europe, Canada, and elsewhere. China's inability to revive domestic demand is exposing it to extreme risk abroad. If the world stops buying because of tariffs, and Chinese consumers aren't buying because of the property crisis, who buys the factory output? Nobody. And that leads to deflation, which is exactly what we are seeing weighing on prices. So, what is the government doing? Top policymakers met last week. President Xi Jinping called for heightened attention. The NBS says they will adopt more proactive macroeconomic policies. But let's look at the actions, not the words. The consensus among economists is that the government will set the 2026 growth target at 5%, same as 2025. They will likely roll out a fiscal deficit of 4%. The People's Bank of China will cut interest rates moderately. My analysis? This is not enough. As Gary Ng from Natix has said, the government policies are far from adequate. A 5% target for 2026 is going to be infinitely harder to hit than in 2025. In 2025, they had the export boom to carry them. In 2026, they faced the Trump tariffs and a domestic confidence crisis. The market knows this. That's why China's 30-year bond futures are trading near lows. That's why the Hang Seng China Enterprises Index fell 1.3% today. Friends, here is the truth behind the events. The data from December 15, 2025, reveals an economy that is dangerously unbalanced. The strategy of production first, consumption later has hit a wall. You cannot manufacture your way out of a balance sheet recession when the rest of the world is closing its doors to your goods. The authorities are currently using piecemeal measures: a little rate cut here, a little subsidy there. They are trying to perform acupuncture when the patient needs surgery. What to watch in 2026? 1. The groundbreaking policy: will Beijing finally unleash direct cash transfers to households or a massive bailout of the property sector? The current drip-feed stimulus isn't working. 2. Vanke: watch this developer like a hawk. Its survival is a proxy for the entire sector. 3. The trade war: as Trump's tariffs bite in Q1 2026, watch for a sudden drop in industrial output. If that 4.8% factory growth drops to zero, the GDP target becomes a fantasy. The year 2025 is ending with a whimper, not a bang. The one-legged giant needs to heal its domestic leg, and fast. Until Chinese households feel confident enough to spend again, all the factory robots in the world can't save the growth figures. Keep your eyes on the data, not the slogans. That's all for today's Boss Economic World. See you next time.